the different, well, kind of the financial statements that you'll see, the financial report you'll see from government agencies. It's ACFR. I emailed it out. It's also in the. Do not print this thing out, by the way. This thing is 400 pages. I should have put that on there. Do not print this, 400 pages. But this is the Illinois one. This is the latest one. I don't know why they don't have June 2022 out. Anyway. Okay. Oh, here's something that's interesting. The term here. The head accountant for any organization is called the controller. There was a government memo that had a typo in it in the 1930s that spelled it so it looks like comptroller. And you'll hear people call it comptroller. It actually is pronounced controller, but it doesn't really matter anymore. But anyway, so government agencies, the controller, the head accountant, it's spelled that way. But it's kind of funny that it was really kind of an obscure memo from a government agency that caught on. That's what you call it. Anyway. So anyway, this thing it's a big thing, and it gives you a breakdown of all the stuff. Like I say, this thing's 400 pages long. We're going to look at some of the financial statements. The one that we covered so far is the government-wide one, statement of activities, which we'll talk about. Okay. All right, so this is statement of activities. We'll go back to this one later. This was kind of interesting. Statement of activity. So this is kind of what we did before. This is what we did last class, and we'll. I think I gave one for homework where you put the expenses first, right? So here's the expenses. Over here are how they got money in. For those. Same thing for business type activities down here. Component use something a little different that we didn't cover in this class. But you can kind of see this is stuff that's not usual for, at least for cities. They usually don't fund their own university stuff. Now this goes on to the second page here. So the second page is the net revenues. And coming down here to the bottom, this is kind of where we're at. And in this case, they looks like the total change was, I think these are in thousands, so this would be 54 billion, I would think. Let me see, make sure that these are in thousands. Yeah, expressed in thousands. So here's the net change is 54 billion. And so a lot of times you're talking about really large numbers of things like say like states and that. And Illinois is a big one. Okay, now here's where you may have heard that Illinois is not doing terribly well financially. And this kind of shows us why. This starts out a little bit different than we have the liabilities first, and then it has basically what would be your these would be like sort of like the assets, and this is, you know, net position, what they actually come up with that they actually own, and it's negative $199 billion. These are the liabilities that are due in more than 1 year. They're absolutely massive. 200 and close to $237 billion is due, and you might be wondering what that is. You know, why does the state of Illinois have this big? Why do they owe this much money? And I don't. Has anyone gone through? Has anyone been through this or anything? What it is?
Is it teachers 401k and retirement plans?
Yeah, the pension funds. The pension funds are massive. And this is one of the really weird things about Illinois that happened years ago is, for a long time, the state of Illinois would pick up the pension costs. And these are what are defined benefit. These are not, they're not like the 401k so much, which is what people have now. These are when they would tell people, look, when you retire, we're going to give you 60% of your salary for the rest of your life. And so whenever they came around to contract negotiations, well, if you're the city of wherever in Illinois, and you know that the state will pick up the pension, you give them as much pension, you know, you load up the pension and you make everybody happy. And, you know, that was just what went on for years. And so anyway, these are massive pension payments, and these go to, teachers. There's also for Illinois, for like Chicago, the police, they have these massive, what they call defined benefit pensions. And when they were first giving these out, you know, a couple of things happened. You know, is where you say, well, didn't anyone pay attention? What was going on? Well, here's the thing. Not that long ago, the life expectancy was fairly short. For instance, the average male, I think, lived to be 68, over that 67, 68 or something like that. So you go, okay, well, they're going to retire and they're probably going to die within a couple of years, or most of them will, or whatever. So, you know, these aren't going to be that big. They're not going to live that long after they retire. They didn't count that many people were going to be living into their 80s, 90s, you know, that was going to be, so that instead of them being around for 2 years, that they were going to be around for 25 years. It was unthinkable back then. Back then, you go back to like the 60s and the 70s, people didn't even jog. I mean, there was like, they didn't have gyms, they didn't have, most people smoked, most adults smoked, drank a lot. Their lifestyle was such that they weren't going to last that long. And now things are very different. And so this is one of those things that, it was a complete shift, that instead of someone, people are going to last a few years, that they're going to last decades. And as they age, of course, you have things like healthcare and things like that just balloon up. Well, it might sound, crazy now, like, well, were they just stupid, or what did they? Yeah, there was something about that they didn't really plan on, that people were going to be living longer, living healthier, and all that kind of stuff. So there was this huge, amount that really started to balloon up, and now most of them are what they call defined contribution, like the 401k things, that they'll put in a certain amount that will go into an account, and that account will be held for those people when they retire. So anyway, that's what these are. These are these huge amounts, and that's why Illinois is basically bankrupt. And the city of Chicago is basically bankrupt, and it's because of these pensions that are out there. Now, there have been cities that have declared bankruptcy. So it's been predicted that Chicago at some point is going to have to declare bankruptcy. I don't know if that's going to happen, and basically what they do when they declare bankruptcy is oftentimes the pensions will be part of that bankruptcy, that they'll restructure the pensions or whatever. Whether that happens in Chicago, I don't know. There's never been a state that has declared bankruptcy. So it'll be kind of interesting to see. Another factor that came into this, though, was that governments were looked on that, look, a government cannot go bankrupt. Why? Because they can tax. And because a government can tax, they can never go bankrupt. That was also a very strong feeling back then, that, you know, they have the ability to tax. So if they do get behind, well, they'll just tax more and they'll get out of it. You know, it's not that it's built in that they can't fail. Well, now we know that that's not true, and that there's only so much you can start taking, and there are a lot of places that if you don't have a tax base, those costs aren't going to get covered. So anyway, yeah, all these things kind of came out, and this is not, this is not unique necessarily to Illinois. There's other places that have gone through it, but Illinois is by far the state that the state government has such a huge liability that basically everybody in the state of Illinois owes ballpark $20,000. The new baby that's born in the hospital, there's your bill, $20,000. So, and that's something unique to Illinois. Now, another thing that is true about all this is that the accounting was not that good. These government-wide financial statements that we have now, that we've gone through, at least went through the one, those are fairly new. Those came about in 1990. Now, remember, this had been going on for decades. So by the time 1990 rolls around, people are living longer. They're living into their 80s, 90s. It's not uncommon. So you started having this, the accounting that was done by the year. Here, I'll show you. Let me show you financial statements here. So you want to get to a fund accounting. So this is basically what we would be looking at for this is the only type of balance sheet that they had. This is on, what page is this, 44? If you look on page 44, this is the type of balance sheet the only balance sheet that they would have before 1990. The assets were all current assets. It was a checkbook. The liabilities were all current liabilities. They had no long-term liabilities. Look at the liabilities here. It's 15 billion rather than whatever it was in the other one, 260 billion or whatever. It's 15 billion. No, yeah, 15 billion is a large number, but nowhere near as big as 270 billion. So these are the financial statements that people would see. And look at these, they still have a fund, they still have a deficit in the fund, but not by much. And if you combine both of them, the total governmental. Oh, they still have, never mind, they still have a negative on the fund balance deficits. Looks like the unassigned. So anyway, yeah, so they have these primitive, you might say, financial statements that didn't show long-term liabilities. No one knew. And pensions, they didn't even account for. They didn't account for pensions until late for companies. Just to give you an idea of, the magnitude of it for businesses too. I worked for Navistar. They used to be International Harvester, which made tractors and maybe trucks and everything. But large company, company. And we had, when I was there, we had 11,000 employees. We had 39,000 retirees. We had, more than 3 retired people for every 1 person working in the company. And that was very common of these big, large industrial companies. So it's not just for states, it's also for companies that they have these very large, what they call defined benefit. That we're gonna pay you this amount for the rest of your life, those kind of programs for retirements. And again, they thought people would live for 2 or 3 years and they're living for 2 or 3 decades. It's a big difference. So yeah, so these defined, but and like when I was at Navistar, we had more assets in the pension fund than we had in the company. The rest of the company, the operating company. The pension fund was bigger than the operating company. And believe me, when we did audits, and I helped with these, we really went through the pensions. Because those are the biggest numbers. And then we had 35 pension funds. And I worked with Deloitte and Touche. I was an internal auditor. I worked with Deloitte and Touche because, just because I had done work with this before. So, but anyway, huge dollar in there. So, if you're wondering like how I got there, well, that's kind of how I did. So a lot of it is to blame on the accounting. They didn't have statements like this that show the total liabilities. They didn't have this $237 billion that's due, long-term stuff that's due. They would only have the current, 15,000, whatever it was. So anyway, so this is the report, and there's a whole bunch of stuff in here. They go into everything. It's very, if you ever want to find anything about the finances, especially of Illinois, go through this report and you'll find everything. Page intentionally left bright. But anyway, we have a report on here. I was looking to see if they had a. I'm gonna go up to the top here and see something. I'll tell you what I'm looking for. I'm looking for an auditor's report. They don't list it separately. Oh, independent auditor's report, 11 through 15. Okay. Oh. So here's the auditor's report. So if you go into be a CPA, and by the way, one of the good niche markets for being a CPA is being in auditing governmental agencies. We always think about CPAs auditing companies, IBM and whatever company, Ford and all that kind of stuff. But they also, a lot of these cities and municipalities and states, obviously, they have to get audited. And those are a lot of times those are specialized either CPA firms or groups within the CPA, larger CPA firms that do those. And it's a good market. I mean, it's a very stable market, right? It goes on, and these are huge audits. Okay. So it goes through the same responsibilities and all that kind of stuff. Opinion per unit. For some reason, we got a qualified here. That's interesting. The business type activity's got a qualified opinion. And they got a disclaimer. On the unemployment compensation fund. So that's kind of interesting. A disclaimer opinion means they don't have an opinion. So it looks like they were unable to get an opinion on it. And this is qualified, that's a bad opinion too, also. By the way, a disclaimer of an opinion, I don't know if you guys had auditing yet, some of you had. But disclaimer of opinion means that there's no opinion. Qualified means that there's a problem. Oh. It's due to this. Unemployment compensation trust fund that is linked to the business type. So what they're saying is that, hey, we found everything we need except for this. These two are connected. Because the business type activities also, I assume, pay the unemployment and have that set up. So, all right. So anyway, this is, you can go through here. Emphasis of matters, those are kind of interesting. Deficit increased, blah, blah, blah. Okay, so everything you see is in that the ACCT414 report, annual comprehensive financial report. And again, even if, you know, a lot of times, if you're looking for even something obscure, a lot of times you'll find it in there because they're huge. 400 pages is not unusual. I've seen them up to 700 or 800 pages. So they get really big really quickly. Okay, now the next thing I'm going to cover is a little bit, it's a little bit awkward, but let me get rid of this. Social responsibility, and I'll tell you why it's a little bit awkward. We want that. Oh yeah, this is what we want. So I'm going to go through this. There's actually 3 different things included in here, and they're all good stuff. Okay. The first thing is the report that we just saw is called the ACCT414. It wasn't always called that. This is fairly new. This happened a couple years ago. Well, actually like a year and a half ago, I guess. And for good reason, they changed it. It went to this is what we call it now. It used to be called this. And you'd say, well, what's the difference? You know, now it's annual comprehensive financial report. It used to be comprehensive annual financial report. The problem was that people would often call it this, which is a offensive slur in South Africa. So even though the report itself had nothing to do with it, the way people would refer to it was. So they changed it. And you know, I'm sure they had no idea that it was, you know, that there was a term there. But anyway, so they changed it, and just to let you know how serious this is, it's considered hate speech. In South Africa, it is considered harassment. We call it hate speech here, but there they kind of refer to it as more like harassment, and it's legally actionable. You can be arrested for it. It's also kind of interesting, though, how they came up with, you know, because they basically have to go through how they justify whenever they do a change, and so they went through this. And one of the things they said, hey, it's, you know, it's a little direct call. You're just switching 2 words around. Right? I mean, it's not, you're not really doing anything. And if someone is searching for, you know, this, they're going to find this. So, you know, one of the things they said is, look, there's, you know, this is a change we can make without too much of a headache, and it's worth it. You know, it's worth it to do it. Now, unfortunately, I think you can check in your book, but they still list it as this in mine, which they shouldn't do. You know, this is not what I'm surprised it's because this is online. I'm surprised they haven't updated that. I don't know if your guys' version of it has it updated or not. But this is the old terminology. And it should not be used. But anyway, it's in there. And I assume that the next go around, we'll get it out. Now, there is a couple other things though that's kind of fascinating about this whole accounting thing in South Africa. Because there's these things called the Sullivan Principles, which were, well, here, let's just read it out. I don't know why I'm telling you this. So the Sullivan Principle. Leon Sullivan was an African-American minister who was a member of the board of General Motors. And he came up with what has become known as the Sullivan Principles. And here's the Sullivan Principles. Now, these were not specifically made for South Africa. These were for any, all companies. And you go through these and they're very much, ideas that most people hold near and dear nowadays. But these were the principles that he wrote out that all companies should have. And he went around and would talk to companies to get them to sign these, the Sullivan Principles. Most of them at first didn't, but after a while they would. Now, of course, South Africa was one of the worst companies as far as these principles on earth. They actually had a legal system of segregation between blacks and whites, and very limitations on what black people could do and all that kind of stuff. It was just horrible. And a lot more and more of these companies, a lot of things at times I think they signed on just to sign on, but I think over time they said, look, they either ignored the rules, look, we're going to let black people move up in management and we don't care what you say, and they would just blatantly ignore them. Sometimes they would they left. They would say, okay, we're not going to do business in South Africa until you guys get this. Now, apartheid kind of started coming apart really early in the 90s, and after about I think 94 was when they actually reached an agreement on it. And the whole idea between that time was to try to avoid violence and stuff, but which they did by a lot in large. But they but anyway, so I really think that a big chunk of that change came about because of these Sullivan Principles. Because so many of these companies said, look, we signed this thing and this is obviously terrible, and either we're going to ignore their rules or we're just not going to do business with them, period, because of the way, and so that's what happened. And so in the government, there was a very, what they would call now, conservative, and conservative people, the conservative government, they always kind of felt that they represented business in that, and the businesses were leaving. Businesses said, forget it, we're not going to stay here to do this. So 125 companies doing business adopted them, and 100 of these stopped doing business in South Africa. This was a little bit controversial because obviously there was people working at these places who didn't want them to leave, but in the end, it was one of those things that really caused the change. And so here is, negotiations in the early 1990s and apartheid in South Africa. It took a few years to do it, but so these principles, this was just and this guy was a board member of General Motors. It's hard to imagine anyone having a bigger impact on, more people or whatever. Okay, coming down here. Now, this is another interesting tie into accounting. It used to be that ethics and social justice and all this kind of stuff. That was not the job of business. You're in business, your job is to make profits for the shareholders. If you want to be political, quit the job, go into politics and do whatever you want, but you don't do that with the company. This company is, you have a fiduciary duty to the shareholders, and that means you don't make political statements about anything. That was kind of the overriding thing. And it's just kind of, one of the things is it's almost unbelievable is how ethics was never taught in business for years. And I kind of came through that time. I graduated high school in '82 and graduated college around 1990. I took a long time. I took actually a couple of years to do it, but I ended up getting my master's. I think it was '91 actually. But anyway, when I first started, I mean, it was, ethics was not taught anywhere. And if someone would have talked about ethics, they thought they were bizarre. But anyway, over that period of time, though, things had changed. And so, companies kind of went from being, hey, you don't get into politics. For instance, the first business ethics conference was held in 1974, which maybe it's a while ago, but I mean, it's not like 100 years ago. It's not like it was held, 1874. It was held in 1974. 5 years after, we reached the moon, they started talking about business ethics. And in 1988, which is not that long, well, I guess it's a little long ago, but 1/3 of MBA was only being taught in 1/3 of MBA programs, and it was not a separate class usually. It just means that it was being taught, not that it was a class or anything else, but that they actually mentioned business ethics in 1/3 of supposedly the top thinkers in business. And to be honest with you, most businesses, if they're only there to maximize the profit. And if any companies, signed a social responsibility statement or put it out, they pretty much thought that it would be ignored by the market, that no one cared. Then came this study. And this study looked at the companies that signed the Sullivan Principles. And the author, Dennis Patton, wanted to see if companies that sign, what happened to the market price of the companies that signed the Sullivan Principles? And we compare that to companies that didn't sign. What would be the difference between them? And it was pretty dramatic. When companies released the statement that they had signed the Sullivan Principles, they had all kinds of activity on their stock. The price did go up a little bit, but it's hard to say. It's always hard to pin down like stock increases and decreases. It's hard to tell if there's other market things involved. But when these statements came out, and they could isolate them, is when they came out and look at the different their competitors, it made a big impact on the market. It was obvious that something was happening. There's something going on. And there's further studies later on that showed the companies that signed the Sullivan Principles actually did financially better than companies that didn't. It could be attributable just to having better management, but it could also be that the people who were investing saw the value in that, which nowadays is kind of a given. There's either some funds that they won't even invest in companies unless they have a certain amount of what they're doing, put in statements like this. So the social responsibility thing, it became, okay, this isn't just some silly thing that you shouldn't be doing in business. It actually is something people want. Now, here's how this kind of comes about today. So, so the guy who did the study, Dennis Patton. And again, the study showed that maximizing profit may include those things, which no one really thought of at the time. But Den Patton, he was my first accounting teacher when I was down at Illinois State University. When I was down at Illinois State, I had my undergrads in finance, and my first graduate accounting, my first accounting class wasn't a graduate class. I had to make up some accounting classes. I was not a very good accounting student, by the way, when I first started. But anyway, he was my first guy, and he was talking about this, and I remember that, you know, it was such an odd thing to hear in a classroom that this actually, you know, made a big difference in it. Okay, now here's how this is manifesting itself today. So now there's all these companies that are just kind of putting out these statements about, you know, social justice, about being green, you know, being good for the environment and all this stuff. They're making all these statements, promises, statements, you know, statements of fact and all that, that now they're starting to become audited. Now, here's the crazy part. So CPA firms, we already have standards set up to do these audits, but there is no regulation on who can do them. You know, CPAs can audit financial statements. There currently aren't any standards as to who can audit these statements as far as social responsibility, environmental responsibility, and all this kind of stuff. That those are like the big areas now, because they are so important that companies are using this to prove they don't need to, but they're using it to prove that they are, you know, they're actually doing what they say. So it's the Wild West out there for these audits of these social responsibility and environmental responsibility. There are anyone can do them. Some companies have them done, some companies don't. But the fact that they're doing it on their own, they're spending the money to do it on their own, kind of tells you how important it's becoming. That companies think that they need to get an audit of these things that they're saying that they're doing, that it's worthwhile. And here's another kind of humorous thing. If you read the auditing company, you know, the auditing firms, CPA firms, when they do the audits, they're very cut and dry. They're very matter of fact and all this. Whereas you see these other places that do it, and it's kind of hilarious because they use all kinds of crazy things that you can never use in an audit. For instance, in auditing, you can never be an advocate for your client. You can't say this, you know, this client's a great person. Well, firms that aren't CPA firms, they do it all the time. Oh, president such and such of the company such and such is such a great person, and you know, all this kind of wacky stuff in there. Point being is that it really shows the need for standards when it comes to auditing, even things like, you know, social justice and environmental stuff and all that. So anyway, so that, you know, the day like that is a huge thing. It's a huge problem, and it's also going to be interesting to see how it all works out. Who knows? That might be like the next big thing, is to be an environmental auditor or a social justice auditor, social responsibility audit. Okay. Okay, one more thing, and then we'll take a break, and that is, what am I doing here? Yeah. I want to talk a little bit about types of audits. Sketch that, types of funds. All right. I don't think we talked about this before, but there's a whole bunch of different funds in accounting, and they all do different things. But it's a good idea to kind of, and now I think you guys are used to a little bit more of the mechanics of it. Transfers to, transfers from, due to, due from, all that kind of stuff. Expenditures and encumbrances and all that kind of stuff that, you know, you kind of used to the nuts and bolts of it. But now I think it'd be a good time just to kind of get a handle on what actually are the different funds and what do they do. can't really complain about Zoom. Zoom has so many pop-ups now that you can't see your screen for 5 minutes. I don't know if you guys get that or not, but anyway. Okay, so governmental funds. General funds. Administration, education, public works, so they can be any number of them. There is no set group of funds that, you know, you can have. Some general funds, they have 3 of them, some they have 30. So there is no specific amount. Special revenue funds we talked about. We actually did a journal entry on them. They can only be used for a specific purpose. For instance, gas tax can only be used to maintain roads. They are special and that they are not earned until they are, let's put that in. These funds are not earned until they are spent. So unless you spend them, you don't earn them. And they have to be spent for the particular purpose. Debt service fund. This was the only fund that back in the day people could look to see what the long-term borrowings would be. And this fund is used to pay off long-term borrowings. And they generally get transfers from, say, the general fund. It could be other funds that they get transfers from too, but for the most part, from the general fund, they get transfers. And these are to pay off long-term borrowing. So things like bonds. Paying out bond long-term loans, all those kind of things, long-term. And again, in normal fund accounting, you don't see those on the balance sheet. Capital projects funds we talked about. Hey. For buildings or major repairs of roads, sewers, buildings, etc. Permanent funds. These are generally what they call endowment funds. And endowments are usually that they can spend the income from the endowment. I don't know why I. So these are all under the governmental funds. Proprietary funds. We talked a little bit about this. We did the statement of activities. Enterprise funds. Okay. Enterprise funds. Airport, stadiums, zoos, whatever. These usually go with the business type activities on the government wide. Internal service funds. These usually go with governmental activities. Now, here's the difference between these two. The enterprise funds serve the public. Or at least mainly the public. You know, airports, zoos, whatever, the public comes in, they go to the, the stadium, the airport, the swimming pool, the zoo. So these are groups outside of the government. Whereas internal service fund, they're only servicing other governmental funds. So there's a difference there. These are internal. And because they're internal, they're generally looked at as governmental activities and not really business type, even though they keep their books as if they are a separate business. All right, fiduciary funds. Fiduciary just means that you're keeping track of it for somebody else. We're not going to get too far into these, but you can kind of look and see what they are. Pension fund, trust funds, whatever they have trust funds set up for. You as a government agency, you might be, like I said, the trustees of these things. Private purpose trust funds, these are ones that can be spent on certain things. And custodial funds kind of fall into the everything else category. Now, these are funds that they look after, even though they don't fall into any of the first three categories. So fiduciary just means you're doing it for somebody else, like a fiduciary duty. Okay, the last thing before we go on break, the wacky fund balances. Fund balance used to be very easy. Fund balance is sort of like the equity section. Like we have common stock and retained earnings. Fund balance kind of is both of those. The difference being is that nobody owns stock in the city of Chicago, right? So the fund balance has basically is sort of like the stock and the retained earnings for the city, the state, the whatever governmental unit you have. So the fund balance, and by the way, for like for the general fund, not only will the general fund have their fund balance, but all these other funds will have a fund balance too. They'll have their own separate fund balances. So back in the good old days, back when I was going through, we had reserved and unreserved fund. They would either be reserved or not reserved. It was either one or the other. Nowadays we have several categories of those. Non-spendable. Non-spendable is if you have, for instance, the current asset of inventories on your books. Say, okay, we can't spend our inventories. So if we have a box of, I don't know, pencils, we can't spend the pencils. Restricted. These are things, these are the most restricted category there is. You're stipulated by Constitution, external resource providers, or through enabling legislation. So these are the things that are beyond the control of the local government. So it's beyond their control. They get these funds, but they cannot just do what they want with them. They are restricted by external forces. Committed are by the highest level of decision-making authority. So the highest level of authority is making the decision on those. Assigned are basically the lesser things. For instance, if you're let's say that you're running you're in education and you have a program for bilingual students, and you are setting aside money for that. That probably doesn't come from the mayor. It could, but probably not. But those are funds that you'd set aside, and those would be assigned, by whoever's in charge of that fund. It's not going to be the mayor. It's not going to be the state or federal government. It's going to be assigned at a lower level. And those are the amounts that are assigned. They're assigned for a purpose, but they're not by the highest level. And unassigned is basically everything else. And one note, we did have a budgetary fund balance, but that is not included at all. It's not really a fund balance. It's a budgeting account. So that budgetary fund balance does not count as a true true fund account. It is a true budget account. It's just not a true fund account. Okay. Well, that's all the sort of dry talky stuff. So the next thing we're gonna do when we come back is we're gonna finish up the textbook problem. We did the first one. And now we're going to do. Hey, let's say be back at 7:03. Is that right? 10 minutes? Okay, so when we come back, we'll continue on with problem 38 and 39, and that'll be it for tonight. We're gonna finish up this problem. So be back at 7:03, and I promise we'll do some number stuff. Sorry about the last minute or so. I was just talking to myself because I was muted. But anyway, so this is what you should have gotten for homework problem number 2. And we have the beginning and ending fund balances here. And the change in fund balance was the 350,000, so it went from 1,800,000 to 2,150,000. Okay, so let's go back to where are we? Oh, so anyway, that's what this is. Government-wide, this thing. If you want to get if you want to get a screenshot of it, if you came with something different, feel free. Okay, let's go back to the problem. Now, government-wide financial statements, you can pull out the handout if you want for that. Maybe that's not a bad idea, actually. Oh, I got it on a different place. Hold on. Okay, so this is the government-wide one. And everything is fairly similar to what we had. The difference is that we don't have any of the budgetary accounts. Yeah, we don't put encumbrances on purchases and things like that. Okay. So a new truck was ordered. What do we do with that? So this is government wide. What do we do when the truck is ordered?
Wouldn't it be an encumbrance?
If it was fund accounting, and we did that last time, was fund accounting, yeah. You know, this is fund financial accounting. So down here, so this is government wide. So this is the second set of books. These are different books. These are the ones that are more like our normal accounting. And in our normal accounting, when you order the truck, you don't do anything with it because you don't owe anybody, you know, until they show up with the truck, you don't owe them anything. So this would be no entry. So this is no entry for government wide. Yeah, it's like this kind of that first one we did where when we order the truck, it's just like regular accounting. You know, the government wide is similar to regular accounting. In that we order the truck, well, until they show up with the truck, we don't owe them anything. There is no transactions actually happen. So fund accounting. We put an encumbrance on the book, put our hand on the money and say, don't spend this money. This is our checkbook. We say, don't spend this money out of the checkbook because we need it. Government-wide accounting. No entry. It's more like this is like regular accounting. Maybe that's a bad way to say it, but like I say like regular for profit. Okay, here is another quirk, not, I don't say quirk, but another um thing about the well, and I gotta actually I gotta pull up the other report. Just think. The city print shop, internal service fund, did $1,200 of the work for the school system, but has not yet been paid. Okay. Now, when we're doing fund account, when we're doing fund accounting, you know, this between the two groups, we have this due to and due from and all that kind of stuff. When it comes to government wide, they say, look, if it's included in these governmental activities, if you transfer from one to the other, we don't care. It's kind of like if you're in a company and you transfer a desk from marketing to operations or whatever it is. It doesn't make any difference. So things that are included in the governmental section, the governmental activities, those things, if there's transfers between them, we don't do anything with it for government wide. So this one would also be no entry. Now, they do record transactions between. Nope, okay. They do record transactions between governmental and business types. They do record those. But within the departments themselves, they do not. Okay, C is a big difference between here's fund accounting. Fund accounting, we pick up the cash. We'll do that too down there. But then we have this other financing source, bonds. This is not a liability. This is like almost like a revenue account, like pennies from heaven. We need $11 million. We got $11 million. Woohoo. Going down to our regular for-profit accounting, we say, okay. We got the cash. Ah. $11 million. In regular accounting, what would this be? We issued a bond, we're gonna have to pay it off in the future.
Funds payable?
Yep. Exactly right. We have long-term bonds here, so this would be. Oop, it's not an asset. It's a liability, but it's also going up. So you know, so this government-wide accounting, they actually say, look, we have long-term liabilities, we have things we got to pay off in the future. And you know, we'll put these long-term liabilities on the books. So notice the difference between that, it's. So this is government. I'm gonna keep putting government wide here so we know. I didn't put fund accounting on the other ones. So government wide, we put the payable on the books. Fund accounting, there is no long-term liabilities. It's short-term liabilities, and if we do have a long-term, it's woohoo, we got a bunch of money in that we can now spend on whatever we're gonna spend it on. New library, whatever it is. By the way, yes, this is one of the reasons why why states and cities get into trouble. Because they finance a bunch of stuff with long-term debt without, the adequate future orientation to figure out they're gonna have to pay for that at some point. Okay, now, city transfers cash of 140,000 from its general fund to provide a permanent financing for a municipal swimming pool. That would be maintained as an enterprise fund. Okay, so there's a lot there. So it's kind of like this, it's being transferred from the general fund to an enterprise fund, kind of a business type activity. So there's, like a swimming pool. Which again, this is not just for government. Right, I mean, this is for the general public will, I assume, go there and use a swimming pool and, that's how they're gonna make money on it. Okay, so we will have this transfer. So. Let's see. They actually transferred the cash went down. Oops, that's not right. What did I do here? There's an asset going down. Try it again, going down. 140,000. And this will be a transfers out. So this will be a transfers out. And I guess you put it in their swimming pool. And the swimming pool, by the way, well, it depends on how it's set up. It could be a swimming pool, it could also be could be a capital projects fund. But they would pick up the cash and have transfers in. And again, why do we do it for this one? Because it's between these two funds, two types of groups. It's between the business type and the general governmental activities. So it's between those two. So we do pick up the transfers going from one type of a activity to another. And this is almost like an investment, by the way, because if the swimming pool makes money, usually the city gets the money. Okay, so here we have truck ordered in A is received, but an actual cost of 96,000. Excuse me. Payment is not made at this time. What's the journal entry going to be? Oh,
Would it be a equipment or truck of $96,000?
yep. Either one's fine. It's gonna be an asset. Going up. And on the other side, we're gonna have what?
It's not accounts payable. What is it again?
Vouchers payable probably. That's the. It could be voucher, but if it was a loan, it might be a loan payable. It would, for instance, if it was a long-term, a loan for like 5 years, you'd have loan payable. If they're gonna pay it off in cash, it'd be vouchers payable. Some type of payable. City transfers 32,000 from general fund to capital projects fund. The capital projects fund is with the general fund. It's in the same group. First capital projects fund in Chicago will be the general fund in Chicago. So this will be no entry. This is an internal activity. Okay, city receives a state grant of. Oh, this is a special revenue fund. How about special revenue fund? This is it. Yeah. So it must be spent to promote recycling by citizens, so we can only use it for recycling. It's very specific and you must use it for that. If you don't use it for that, it will never be earned. Okay, I will put in the easy part. They received a grant of 30,000, so it looks like they must have received the cash, I'm gonna assume. It's nice about cash either. Oops. What's gonna go on the other side?
Is that going to be to be like due to for motorcycling?
It's sort of like that. It is gonna be a liability. But we're not gonna, when we spend this money, we can pick it up as revenue. So until we do though, we're gonna probably call it unearned revenue. But it is a liability. It is like a due to, in that if we don't spend it for recycling, we have to send it back. But at least initially, we're gonna call it unearned revenue, because I assume we're gonna at least try to spend it. And I would imagine that if you didn't spend it, you would probably, probably make a journal entry to make it a due to, because you'd have to pay it back. First 5,000 of the state grant received is expended as intended. So instead of being an expenditure, which we normally have for fund accounting, this is going to be an expense. Probably some kind of recycling expense or something like that, but some kind of an expense. You put recycling expense going on there too. Either one. For 5,000. Expended, so we spent it. So what's going to go on the other side?
Cash will go down by $5,000.
Yep. Cash is going to go down by 5,000. Okay, now, so here's the kind of interesting thing about this. Now we've earned this money. Once we spent it, now it's earned. Here. So now we're going to pick up, well, we're going to reduce our liability here. We're going to reduce it by 5,000. I like that you said that due to, because it would, you know, this probably would be due to another fund. Yeah, it would be due to the state. Never thought of it. The unearned revenues is a liability. This is going down. Now we have earned this 5,000, and we will now pick it up as regular revenue. You can also say grant revenue if you wanted. That's fine. I'm just gonna put down revenue because I'm lazy. So now we take it out of the unearned, and this is just regular old revenue. You can put earned revenue if you wanted. That's fine. In governmental accounting, we usually don't talk about earned revenue, but in this case, it would be because you earn it when you spend it. I think that's it for that one, right? Yep. Okay. Okay, now, any questions on that thing? I'm going to problem 39. I'm going to be giving you guys a choice. So we can start out with fund financial statements. Or government-wide. So government-wide is what we just did. Oh, I know, we can do a poll. Of course, yeah. Okay, so here's our poll. I'll let you guys decide which one you want to do first. A. B. So this will be number one in the poll, and then question. So this will be a little question one. You know, like I said, I can make a poll that only has one question on it. That's what I should do instead of 10. So this will be question one, and then you're also going to have 2 through 10, you can put anything. All right, let's do a poll. So if you want to do fund accounting, which is the wacky one with the encumbrances and all that, expenditures. Budget, putting the budget on the books, pick A. If you want to do the one like we just did, it's more, it's similar to regular accounting. Pick B. Just so you guys know, it's neck and neck right now. The good news is we got 7 people in the class, so there is going to be a decision made. Of course, that's assuming everybody votes, so. Oh, no. Okay, whoever hasn't voted yet, it's in your hands. Uh-oh. I'm ready for so if you haven't voted, vote one way or another, unless you really don't care, and then I gotta flip a coin. Anyone? Oh, okay. Share the results. Government wide. That's a close one. Very proud of you guys though, and that everybody voted. You know, it's all right. So let's go to government wide. You know, I'm gonna get rid of the poll here. Okay. I goofed up my spacing here. Oh, I know this. I am gonna make a just a yeah. You know, like a 1 or 2, whatever question. Okay, so government wide. Government sells bonds. So this is like regular accounting. This is kind of like what we just did. Government sells $900,000 in bonds at face value to finance the construction of a new warehouse. So what are we going to do with that? It was similar to C on the last.
Well, they sold, they earned cash of $900,000, right?
Yeah. Oh,
And then bonds payable.
Yeah, the cash is going to go up. $1,000. And our wacky fund accounting, we would just say woohoo, other financing sources, but this one we actually say, no, we owe bonds payable. And it is almost like you know, incomprehensible that for so many years they never had long-term stuff on the governmental accounting. When I went through, I think the CPA exam, they didn't have any long-term. The debt service thing is the only thing that you'd have. And that would be linked to like a debt listing, a long-term liability listing. You know, in the account, in the accounts themselves, it wouldn't have any of them. All right, so. B, signed a contract. $1.1 million contract signed for the construction of the warehouse. The commitment is reported if allowed. I'm not sure what that means, but. I'm interested. What does that mean, if allowed? Let's look it up. Is anything, do we owe anybody anything yet? I don't think they constructed it yet. No entry. Nothing's happened yet, and if, who knows, maybe they never show back up and do the work. Until they do, there's no entry. Oh, yep, and there's no entry. Oh, yeah. Government, sorry about that. Government transfers 130,000 in unrestricted funds for the eventual payment of debt. Okay, those are both governmental accounting funds. The government, and then the debt service fund. This is the debt service fund. It's hyphenated. It's a governmental fund. And yeah, that would be no entry. It's like this, they're both in here. The service fund will be in the general government's funds. But there'll be no entry on it.
It's because it's a transfer, right?
Well, you transfer between one fund and the other. Actually, this is, let me see if I have it up. No, I don't. Let me see here. I can show it to you though. So the debt service fund is going to be in the governmental funds. So these are all going to go together, and transferring between these for a government wide it's sort of like they're in the same company. It's sort of like if I took a chair and moved it from, the marketing department into the accounting department. You're not going to make any journal entry for that. The chair is the same. So same thing here. You take funds from the general fund, put it in debt service fund. It's not going to make any difference as far as the journal entries are concerned. Now, for the fund accounting, the general fund will make an entry that they, transferred it, but for government wide, they won't make any entry for. And here's why. The government wide one is sort of the government wide one is what you're putting to people kind of on the outside and want to see exactly what the long-term stuff is, and how this would look if it was like a regular business kind of run. And so if you transfer something inside the company, it's not going to get reported any differently. If you have a chair on the books as an asset, it doesn't matter which department it's in. They don't say, okay, here's a chair in accounting, here's a chair in marketing and whatever. So if you have cash transferred from one place in the company to another, it's just cash. So that's why there's no entry for that. Government received equipment for the fire department with a cost of $12,000. When ordered, the anticipated cost was 11,800. I don't think they paid for it yet. It's the received equipment. I'm gonna assume it was not paid for. Okay, so what would we do with this? Now, remember, this is government wide. We don't have any encumbrances.
You like to buy a.
So it's gonna be like 12 grand for like fire truck debited equipment.
Yep,
Voucher payable for 12 grand.
exactly. Good.
Would you record the voucher payable as 12 grand though? Because it said the anticipated cost at 11,800 was recorded.
Well, yeah, I'm assuming that they're gonna have to pay the 12 is what I'm not sure. It depends if there's a contract or not.
Would you record the full 12 or just the difference of the 800 since it's saying that the 11,800 was already recorded?
Oh, I get what you're saying. I think you know what I think that has to do with? I think it has to do with the other one. I think it has to do with this one. For whatever reason, they left the wording the same. I get what you're saying, though. I guess it depends if you had already, you shouldn't have done that, though. You should have recorded when you ordered it. Yeah. I'm gonna say 12,000 and just but if you want to just put 200, that's fine. If you say, okay, we already recorded 11,800, that's fine. And another thing about this though is that, if there was like a down payment made, 11,800 maybe, and they said, okay, it actually came in at 12, then it would be just 200 on it. Okay, I'm gonna put it in fire though and just say, it's not very well written. But so if you put 200 on it, because it does say recorded, so it doesn't say recorded where, but that's one of those things, when you read CPA questions and you read regular questions from like textbooks and that, you realize how much better the CPA questions are because they're so much, they're vetted so much, but they're so much better. They don't have maybe a grad student or two reading it before it goes into the book. They'll have dozens of people. I actually met people that wrote CPA questions, and we asked one of them one time, like, for multiple choice CPA questions, how much time do you put into doing it? And this guy thought, he said it probably takes between 8 and 10 hours for each CPA question. He said, because you have to go through and you have to check every possibility, and then you have to reword this, you have to reword that, so that it's very specific. There usually isn't a question about what they're actually saying. Whereas this, it's hard to tell. Maybe they put a deposit down of 11,800. It's hard to say because it does say it was recorded. Yeah. Okay, okay, supplies are always a tricky one. And they're tricky in just regular accounting sometimes too. Because sometimes people just expense them. They say they're not material depending on what they are. Okay, the consumption method is used, supplies recorded and then expensed when they are used. So in other words, it's kind of like a regular accounting here. You put the supplies on the books. And as you use supplies, you expense them. Okay, so what's the journal entry that's going to be?
You'll debit the expense and credit cash.
Yeah, here they're not, you're just gonna put it into supplies. Because they're not gonna expense them until they're used, so this would be a supplies book, an inventory account. Sometimes they will just expense them, that's not uncommon. A lot of times small businesses will just expense them too, or any business. So this is supplies, this is like an inventory account. So we have more supplies of 2,000, and then we have like you said, the cash goes down. And then as you use them, you take them out of the supplies and then expense them. So supplies expense and then supplies, whatever you use. What happened here? How come spell check didn't catch that? Ah. Yeah. The money will be paid to reimburse the government, but only after the supplement payments have been made. Okay, so this is actually a tricky one. Because notice that it is not, the money has not been received yet. By the way, sometimes you'll hear people say, well, you know, they missed out on this grant money, they should have got it, whatever. And sometimes because they have to spend it before they get it, if they don't have it to spend, they can't apply for the grant. So you do sometimes have chicken and egg problem, whereas for grants that are not, where they actually don't send the cash until after you spend. So in this case, you put the asset on the books. And you also put the liability on the books. And once you recognize the revenue, you're going to recognize, then you're going to apply for that to receive that cash. So this becomes some kind of a receivable. I want to say due from. Oops. Excuse me. And those will be unearned. And that is a very strange effort. And basically, this due from the state will only be recognized when you actually recognize the expenditure. So when you actually pay the cash out for the expenditure, or expense, I should say, this would be for salaries expense. So it'll be cash, salaries expense, and then you'll transfer that unearned to earned for whatever, 5,000, 10,000, whatever it is you paid. And these due from states will not be paid off until you submit it. Now, if you don't spend all of this, you would just reverse it back off the books. But this would be recognizing the the grant itself. You can also put this in, I guess, as a well, it should be a due to, or due from, I should say. Yeah. Okay. Government mails property taxes. Oh, there's a property tax one. Oops. The total assessment is 600,000. Officials anticipate that 4% will never be collected. The government holds an enforceable legal claim to this money. It can be spent immediately. Okay. I think what they're talking about there is that it's not going to go past the 60 days of the year. It's all going to be collected within the year. All right. So what's the journal entry going to be for that? Oh. Yeah, when 4% will never be collected.
You read it the right way, though.
That's my always optimistic mind. So what's the journal entry going to be for that? So we mailed out $600,000 and people owe it. We don't think we're going to collect 4% of it. There's just the way things are. There's some you don't still collect. So what's the journal entry going to look like?
Will there even be one, since it's not like anything's come in?
Yeah, actually, the property tax assessments are one of the weird ones, in that they are not earned. But whenever you send out the assessments, whenever the assessments are sent out, it's considered revenue at that point. So the question is, how much revenue are we going to show?
So then it'd be the 6,000 minus the 4%.
Yeah, so what you're going to do is you're going to have the taxes receivable, or property taxes receivable, maybe. I can't remember what I wrote that in. And that is an asset going up for 600,000. So you send out the bill. What's the estimate on click? I think, how did I do this last time? It should be current, right? I'm being wishy-washy here, but I'm gonna say taxes receivable current. And this will be estimated uncollectible. Right. It's not letting me do it. Okay. You know, my journal entries are really kind of funny here. Okay, so let's see, it's gonna be 4% of 600,000. 24,000. Yeah, 24,000. Okay, so we're not gonna collect 24,000. That's an estimate. So our revenue. Taxes will be whatever, 576. Hey. Okay, I think what we'll do is. It's already 8, it's almost 8. I tell you what, we'll do this, do you wanna try doing this on your own? Why don't we do that? Try doing problem 3, so the fund financial statement, so this will be similar to. If you look at the fund financial statement handout. Or even the one up above here, so try this as homework, you know, and don't be afraid. We'll put the solution up next week. So homework, the fun ones. They're all fun, but no, they're not. Okay. So yeah, do the fund financing, and this is kind of the weird one that's gonna have the, you know, encumbrances and all that kind of stuff, but we'll go through it next time, but see if you can do this one for, and don't be afraid to make a mistake. All right. Any question on that? Yeah, let's see the last one again. Okay, well, I will see you guys next week, and next week. I think I'm gonna do more of the financial statements that we did from for the governmental accounting, and then also. No, I think that's it. I think that's it. And then we'll have the test on it. Any questions? Okay, good evening.
What?